So ever wonder why the Fed is always cutting interest rates like a barber on a caffeine rush? Well, let me take you on a wild ride through time. Rate cuts didn't just start in the 80s. The Fed's been trimming rates for almost a century. But how long do these rate cut parties last? Hold on, because we'll answer that by the end. 1929, the market goes kaboom. The Great Depression begins. So the Fed thought, hey, let's cut rates. Except they were a little late to the party, and the economy, it stayed in depression mode for a decade. Fast forward to 1953, the economy looks a bit sleepy after the Korean War. So the Fed cuts rates, saying, wakey, wakey economy. And guess what? The economy jumps back up like it had a great cup of coffee. 1957 rolls in with a recession. Enter Eisenhower, he cuts rates. And just like that, by 1958, the economy is back on track. Quick fix. The economy gets sleepy again in 1960. The Fed cuts rates, saying, come on, wake up. And sure enough, by 1961, the economy's back, shaking off the dust. 1970, Nixon's got a recession on his hands, and it's not pretty. Inflation's lurking, but the Fed says, cut rates stat. And by 1971, the economy gets back on its feet. Then 1974 hits. Oil prices skyrocket, inflation runs wild, and it's stagflation time. The Fed cuts rates to cool things off, but inflation's still a beast. The economy eventually calms down in 1976. But woo, welcome to the 1980s. Inflation's out of control, gas prices are through the roof, and the economy's not looking good. Paul Volcker, the Fed chair, first raises rates to crush inflation. But wait, after squeezing the economy into a recession, the Fed does a U-turn and cuts rates like a DJ dropping the bass at a party. The result? Inflation cools down, but it takes a couple of years for the economy to bounce back. By 1983, things finally start rocking again. Fast forward to October 1987, Black Monday. The stock market drops faster than your Wi-Fi during a Netflix binge. The Fed cuts rates in a panic, like they're trying to put out a wildfire with a garden hose. But guess what? The cuts worked. The market bounces back in a few months, and the bull run goes full steam ahead. 1990, we've got another recession on our hands thanks to the Gulf War and sky-high oil prices. The Fed whips out the rate cuts again, trying to bring the economy back to life. By 1992, it's like the economy had a power nap, refreshed and ready to run into the 90s tech boom. 1998 to 1999, the economy is on fire and the dot-com bubble is growing bigger by the minute. But there's trouble brewing. The Fed cuts rates in 1998 after the Asian financial crisis and the Russian default scare. The stock market loved it, of course. Tech stocks were flying high. But little did we know, a storm was coming in the early 2000s. 2001, the dot-com bubble pops like a balloon, and the Fed's back at it, cutting rates left and right. The economy's slow to recover, but by 2003, things are finally looking up. 2008, the financial world falls apart. Housing market? Crashed. Banks? Melting down. The Fed cuts rates like they're giving away free samples. But it takes until 2009 for the bull to really start charging. 2020 hits and boom. Pandemic. The Fed slashes rates like there's no tomorrow, and after a brief crash, the market rockets to the moon. Now it's 2024. The Fed cuts rates by 5%. What happens next? Another bull run? Well, Jerome Powell's got the next move. So how long do these rate cut parties last? Sometimes they're quick, sometimes they last over a decade. But one thing's for sure, when the Fed cuts rates, the market pays attention.